Just like that young entrepreneur, you're going to get a handle on these complex topics by focusing only on direct factual information. We're talking direct citations from the Internal Revenue Code, instructions word for word from the IRS, official government publications. There's really no room for interpretation here, no creative guesswork, just the facts laid out clearly. So you can build your understanding on a foundation that's, well, unshakable. It's about demystifying the how-to by understanding the what straight from the horse's mouth, so to speak, the authoritative sources. So with that foundational mindset, let's shift gears a bit. We've set the scene. Now let's get to the crucial first step for any corporation. Doesn't matter if you're a seasoned CEO or, like our example, a 14-year-old visionary. Before you even think about income or expenses, the absolute first thing is identifying the correct tax return for your specific entity. Seems basic, maybe, but it's packed with nuance, isn't it?
Oh, absolutely. It's foundational. The IRS has very precise definitions, and getting this wrong, it can send you down completely the wrong path right from the start. Our sources are great here. They meticulously break down the specific corporation types and their forms, always with those exact statutory references. So first up, C corporations. These are kind of the default, what most people picture. They're defined by 26 U.S.C. Section 11A, and they file Form 1120. That's our main focus today.
And that's the structure with the potential double taxation, right? Taxed at the corporate level, then shareholders taxed on dividends?
Exactly. The corporation pays tax on its profits, and then if it distributes dividends, the shareholders pay income tax on those dividends. That structure really dictates what's required on Form 1120. Okay, then you've got S corporations. Our source mentions them briefly, notes they file Form 1120S. But the key difference, and it's fundamental, is that S corp are generally pass-through entities.
Meaning the profits and losses flowed directly to the owner's personal tax returns.
Precisely. It avoids that corporate level tax. So the profits, losses, deductions, credits, they all pass through to the shareholders to report on their individual returns. And that difference in tax treatment is exactly why they need a separate form, the 1120S, even though they're still legally corporations. Understanding that distinction is huge when you're deciding how to structure a business. Now, moving on to nonprofit or religious organizations. Our young entrepreneur had one of these, a religious nonprofit. Generally, they file Form 990. But there's a really important nuance here, something our sources highlight, and it trips a lot of people up. Churches and their integrated auxiliaries are actually exempt from filing that annual Form 990 information return. That's under 26 U.S.C. Section 6033A.
So churches specifically don't have to file the main nonprofit form?
Correct. The IRS instructions confirm it explicitly. They say churches are accepted from filing. It recognizes their unique status, reduces their administrative load a bit.
Okay, but is that the end of the story for them?
Not quite. And this is a critical distinction. Even organizations exempt from Form 990 have a filing responsibility if they earn what's called unrelated business taxable income, or UBI. If they earn UBI, they must file Form 990T. That's mandated by 26 U.S.C. Section 511A.
Okay, UBI. What does that actually look like? Can you give an example?
Sure. Let's take our young entrepreneur's religious nonprofit. If they started, say, selling branded T-shirts and mugs to the general public every weekend as a regular business activity.
Like a permanent gift shop?
Kinda, yeah. Or maybe they regularly rented out their church hall for big corporate conferences unrelated to their religious mission. If that income comes from a trade or business that's regularly carried on and isn't substantially related to their tax-exempt purpose...
And it could be UBI.
Exactly. It's basically the IRS making sure tax-exempt entities don't have an unfair advantage competing with for-profit businesses on unrelated activities. And failing to file Form 990T for that UBI, even if you're a church exempt from the 990, can lead to penalties. It could even, in serious cases, jeopardize the tax-exempt status itself. So understanding this UBI rule is incredibly important.
Wow. Okay. That's a vital distinction.
And then finally, for trusts, our sources point out they file Form 1041, the U.S. income tax return for estates and trusts. A trust is basically a legal setup where one party, the trustee, holds property for the benefit of another, the beneficiary. They have their own unique set of tax rules and reporting needs, hence the separate form. So you see, right off the bat, before you even get to income or deductions, nailing down your entity type based on its specific legal definition is just paramount for getting your tax reporting right.
That really hammers home how crucial that first step is. And building on that, our sources also get into this concept of consolidated groups. This seems really relevant if you have, say, a parent company and a bunch of subsidiaries like our young entrepreneur might eventually have with that holding company structure.
Right.
These groups are specifically defined by 26 U.S.C. Section 54AA. And it says very clearly that for companies to file a consolidated return, basically, one single tax return for the whole group, there's a strict 80% ownership threshold. That means the parent company has to own at least 80% of the voting power and at least 80% of the total value of the stock for each subsidiary it wants to include.
Not just a simple majority then. That's high
Yep,
bar.
exactly. It's very precise. But here's where it gets really interesting, especially thinking about our entrepreneurs' mix of businesses, including that nonprofit. There's a key restriction, a statutory bar for nonprofits. This comes straight from 26 U.S.C. Section 1504b1. And it explicitly says that corporations exempt under Section 501, like that religious nonprofit, are specifically barred from being included in a consolidated return.
So even if the holding company owned 100% of the nonprofit.
Doesn't matter. Even with 100% ownership, that nonprofit cannot be part of the holding company's consolidated tax return. It's one of those critical details buried in the black letter law that you could easily miss if you weren't looking directly at the code.
That really shows the strict separation the law maintains between tax-exempt and for-profit activities, even within the same ownership structure. You can't just lump them together for tax filing. So if we connect this to the bigger picture, well, the implications for any learner, our young entrepreneur included, are just crystal clear. Understanding your exact entity type and its specific statutory rules isn't just like a helpful suggestion, it is absolutely foundational. As our sources really emphasize, messing this up, misclassifying your entity, trying to file the wrong form, can have really significant and often expensive consequences.
Like penalties, audits.
Yes, definitely penalties. Could trigger an audit. Could even mean your filing is completely invalidated, meaning your taxes aren't considered legally filed at all. Which just underscores how vital it is to strictly adhere to the Internal Revenue Code and its precise definitions. It's not about what seems logical from a business perspective, maybe. It's about what the law, exactly as written, demands. Getting this initial classification step right, that sets the entire stage for compliant tax reporting. It's the first essential what to do in this whole corporate tax world.
All right, so entity type nailed down. Check. Then our young entrepreneur hit the next big mountain, figuring out where every dollar earned and spent actually went on Form 1120. And for their R&D company, which used the accrual method strictly, that meant a whole new level of precision was needed. So let's shift now to the real heart of it. How do you handle specific financial items on Form 1120, especially focusing on the accrual method of accounting, since that's what the entrepreneur used?
Right, and understanding accrual is key.
Because it dictates when you recognize income and expenses, not just when the cash changes hands, correct?
Exactly. The core principle. Income is reported when it's earned. Doesn't matter if you've received the cash yet. And conversely, expenses are reported when they're incurred, regardless of when you actually pay the bill.
That foundational concept is critical for everything else we're about to discuss. And yeah, it can be a common point of confusion for people used to just tracking cash flow.
Definitely. So with accrual as our backdrop, let's break down how to report specific assets and deductions, pulling directly from the Form 1120 instructions and the code. First up, accounts receivable. These are huge for accrual-basis businesses. They represent money your company has earned but hasn't collected yet. You've done the work or delivered the goods, but the payment isn't in hand.
Okay.
According to the Form 1120 instructions, using accrual means you must, and I quote, include in gross receipts all income earned in the tax year, even if not yet received. So let's say our entrepreneur's logistics business completed a delivery in December. The client won't pay until January next year. Doesn't matter. That income must be recognized and reported in December's tax year.
Because the earning event happened in December.
Precisely. It's tied to the economic event, not the cash hitting the bank account. Now, where does this go on the form? The gross receipts your total income before deductions. That goes on page 1, line 1 of Form 1120. But the balance of your accounts receivable at year end, the actual money still owed to you, that's reported on Schedule L. That's the balance sheet section.
It's going to be well, okay.
Specifically, it's on line 2A, trade notes and accounts receivable. This clearly separates recognizing the income from reporting the asset on the balance sheet. Think of it like this. Your income statement shows what you earned over the year. Your balance sheet shows what's owed to you at that specific point in time, the end of the year. It's a vital distinction for accurately showing the company's financial position.
Okay, makes sense. But what if a client just never pays? What happens to those accounts receivable then? Can you just forget about them?
Good question. What if they go bad? Our sources tell us that bad debts can be deducted. They go on line 15 of Form 1120 under the label bad debts. This is allowed under IRC Section 166, but, and this is important, it's not automatic just because someone's late paying.
Right, you can't just write off every slow payer.
No. The debt has to have become wholly or partially worthless during that tax year. This means you've actually made a real effort to collect it, and you have objective evidence showing that part or all of that debt just isn't recoverable. Like maybe the customer went bankrupt or they've disappeared, and despite your best efforts, you know you're not getting that money.
So you need proof.
You absolutely need proof. And crucially, you have to substantiate this worthlessness with an attached schedule. The schedule isn't just red tape. It's your evidence for the IRS. It needs to detail the amount of the bad debt, the date it was originally incurred, and the nature of the debt, basically, why you determined it became worthless. So for our entrepreneur's logistics company, if a client vanished without paying for a big shipment, they couldn't just deduct it. They'd need to show documentation of collection attempts, maybe letters, emails, and the final reason why it's uncollectible. That precision is key. The IRS wants to see genuine worthlessness, not just slow payments or maybe giving up on collections too easily.
Okay, that's clear. Proof is paramount. Now, what about this other item, deferred tax assets? That sounds abstract.
It can definitely seem that way. Our sources clarify something really important right away. Deferred tax assets are not deductible or includable as items of income, expense, loss, or gain on the tax return itself.
So they don't directly lower your tax bill this year.
Correct. That's the crucial point. Don't think of them as a current deduction or credit. They are mostly recorded for book purposes, for your company's financial statements, because of something called timing differences.
Timing differences? Between what?
Between when an item is recognized for financial accounting in your books versus when it's recognized for tax purposes. They don't always match up. For instance, maybe for tax, your company uses accelerated depreciation, getting bigger deductions earlier. But for your financial books, you use straight-line depreciation, spreading it out evenly. That creates a temporary difference. In the early years, your tax depreciation might be higher than your book depreciation. This means you report less taxable income now. But eventually, that will reverse. In later years, your tax depreciation will be lower. The deferred tax asset basically recognizes that future benefit. It acknowledges that you'll likely pay less tax in the future when that temporary difference reverses itself. It's like a future tax saving you're putting on the books now.
Okay, so it's more of a balance sheet thing reflecting a future potential benefit.
Exactly. And where does it go on the tax form, if anywhere? If it applies, it's reported on Schedule L, balance sheets, line 14, under other assets. And just like bad debts, you need an attached schedule describing what it is and the amount. So just to reiterate why they aren't current deductions, they represent future tax benefits, not current ones. They don't reduce your taxable income today on Form 1120. It's a balance sheet item, recognizing a future economic plus. Understanding that keeps your book accounting and tax accounting properly aligned.
Got it. Future benefit, balance sheet item. Makes sense. What about other assets like actual investments, securities, things like that? Our entrepreneur's holding company must have dealt with those.
Right. Financial assets, things like stocks, bonds, other securities.
Yeah.
The Form 1120 instructions are pretty clear here, too. They say report the year-end balance of investments in U.S. government obligations, tax-exempt securities, and other investments on Schedule L, lines 5, 6, and 7.
So again, the value at year-end goes on the balance sheet. Schedule L.
Correct. You're reporting the value of those holdings at that specific point in time. But the income you earn from these assets, that's reported elsewhere, on the main income part of Form 1120. For example, taxable interest from a corporate bond, or maybe tax-exempt interest from a municipal bond, that income would go on lines 5, 6, or 7 of the main Form 1120 page, depending on the specific type of income.
And what if they sell some of those investments, capital gains or losses?
Ah, yes. If you sell financial assets and have capital gains or losses, maybe the holding company bought shares in another tech startup and then sold them, those transactions are reported separately on Schedule D. Capital gains and losses, and that completed Schedule D must be attached to your Form 1120.
Okay, so it's another clear separation. Asset value on Schedule L, income on the main form, and gains losses from sales on Schedule D.
Exactly. It keeps everything distinct. And for companies with diverse investment portfolios, which can happen even for newer businesses, keeping accurate track of what you own, what income it generates, and any gains or losses from sales is absolutely paramount. It's essential for correct reporting and, frankly, avoiding potential audit issues. This is where meticulous record-keeping really pays off.
That's an incredibly detailed look at assets and accrual accounting. It really drives home how specific these instructions are.
Okay, so we've looked at assets and income, but Form 1120 has a lot more sections. Let's explore some other critical parts our sources highlighted. Understanding gross receipts and assets is just the start, right?
Absolutely. Just the beginning.
First up, cost of goods sold, or COGS. That's on Schedule A. Who needs to fill this out?
Schedule A is really only required for corporations that deal with inventory or inventoriable items and are using the accrual method.
So think manufacturers, retailers, maybe our entrepreneur's logistics business if they also sold backing supplies or something? Exactly. Businesses that buy or make physical goods to sell. They'd fill out Schedule A, detailing their beginning inventory, what they purchased or produced during the year, and their ending inventory. That calculation gives you the cost of goods sold, which directly reduces your gross receipts to arrive at gross profit.
But what if you don't have inventory, like a pure service business, maybe a consulting firm?
Good point. If a corporation has no inventory, the instructions are simple. The section is left blank, and ELOZO is entered on line 2, page 1 of Form 1120, which is where the COGS figure normally goes.
Okay, so again, it highlights that not every part of the form applies to everyone. You fill out what's relevant to your business.
Precisely. It reinforces that need to understand your specific operations and only enter numbers where they actually belong. It's about knowing what to do based on your specific business reality.
All right, next, let's touch on special deductions. These sound, well, special. What are they?
They are. They aren't your typical everyday business expenses like rent or salaries. These are very specific deductions that are only allowed under particular sections of the Internal Revenue Code. Our sources give a couple of key examples. Primarily, the dividends received deduction, which is covered in sections 243 through 245A of the Code, and also the deduction for dividends paid on certain preferred stock, which is under section 247.
Can you simplify the dividends received deduction a bit? Why does that exist?
Sure. Think about it this way. If Company A owns stock in Company B, and Company B earns profit, pays tax on it, and then pays a dividend to Company A.
Okay.
Without a special rule, Company A would then have to pay tax on that same dividend income it received. That income would essentially be taxed twice, or even more times if it passes through multiple corporations.
So the deduction prevents that multiple taxation on the same earnings as they move between companies.
Exactly. It aims to mitigate those extra layers of tax. The good news for filers, though, according to the IRS instructions, is that you have flexibility. If these special deductions don't apply to your corporation, the lines can just be left blank, or you can enter 0A. Again, it's tailored.
Got it. Now, one more deduction that seems pretty significant for many businesses, the net operating loss NOL deduction.
Oh, yes, NOLs are very important. This is governed by IRC Section 172. It's a critical mechanism. It allows a corporation to basically use losses from one year to offset taxable income in other years.
So if you lose money one year, you can use that loss to reduce your taxable profit in a future year.
That's the general idea, yes.
Sure.
It's particularly crucial for businesses with ups and downs in profitability. Think about startups with high initial costs, like maybe your entrepreneur's R&D company. They might lose money for the first few years.
Or any business during an economic downturn.
Exactly. Those losses incurred in tougher years can be carried forward or sometimes backward, though rules change to reduce taxable income in profitable years. It's a significant tax benefit, helps smooth things out.
But I bet there are rules.
Oh, absolutely. The instructions are very clear. Any NOL deduction you claim must be calculated following specific IRS rules, often using an IRS worksheet or maybe Form 1139, and critically, it absolutely must be accompanied by a statement showing exactly how you calculated that deduction.
So again, documentation is key. If that R&D company had a loss in year one, they could use it later, but only if they kept meticulous records and showed their work.
Precisely. Every significant number on this form, especially deductions like NOLs, needs that precise substantiation, no shortcuts. So, okay, we've walked through recognizing income, valuing assets, taking various deductions. We've seen how each piece fits into this Form 1120 puzzle. But how does it all finally come together? How do you get from all those inputs to the actual bottom line, the tax you owe or the refund you get? This brings us to the really crucial final calculations on Form 1120, specifically lines 30 through 37. This section is titled Tax Credits and Payments. This is where all the careful reporting we've talked about culminates. It brings everything together to figure out the corporation's final tax liability or its refund. This section really focuses everything, guiding you to that ultimate what to do regarding payment or refund.
Okay, let's break those lines down. What does each one represent?
All right, let's go through them, drawing straight from the instructions. Line 30 is your taxable income. This is basically your income from line 28 minus your total deductions from line 29C, which includes those special deductions and any NOL deduction. This is the key number your tax is based on, the profit figure the IRS actually taxes.
Got it. Income minus deductions equals taxable income.
Line 31 is your total tax. This number actually comes from Schedule J, which is another schedule attached to Form 1120. Schedule J is where the corporate tax is computed based on that taxable income from line 30, applying the current corporate tax rates. It turns the taxable income into an actual tax dollar amount.
Okay, so Schedule J does the tax math.
Line 32 is simply marked reserved. And it's worth noting this because forms change. Not every single line is always actively used. Sometimes they hold lines for future updates or just leave historical placeholders. Shows how these forms evolve.
Right. Good to know. Not every line needs a number.
Line 33 is your total payments and credits. This also pulls from Schedule J. This is where you add up everything your corporation has already paid towards its tax bill during the year.
Like estimated tax payments.
Exactly. Estimated tax payments are the big one here. But also, any tax credits the corporation qualifies for, maybe R&D credits, foreign tax credits, things like that. These are direct reductions, dollar for dollar, against the tax calculated on line 31.
Okay, so tax calculated minus payments already made and credits earned.
Then, line 34 is for the estimated tax penalty. This might apply if the corporation didn't pay enough estimated tax throughout the year. There's usually another form, Form 2220, to calculate this if needed. It's basically the IRS encouraging companies to pay as they go.
Makes sense. Don't wait until the last minute.
Line 35 then shows the amount owed. If your total tax, line 31, plus any penalty, line 34, is more than your total payments and credits, line 33, this line shows how much you still need to send to the IRS.
That's the bill.
Conversely, line 36 shows an overpayment. If your payments and credits, line 33, were more than your tax plus penalty, this line shows how much the IRS owes back to the corporation.
The potential refund.
And finally, line 37 spells out what happens with that overpayment. It's the amount to be credited or refunded. You usually get a choice.
Yeah.
Apply it to next year's estimated taxes or get a direct refund check or deposit.
Wow. Okay. That sequence really clarifies how you get from profit to the final payment or refund.
Exactly. And it raises that important question, doesn't it? How do all these different pieces, gross receipts way back on line 1, specific asset reporting on Schedule L, deductions scattered throughout, credits from Schedule J, how do they all fit together so logically? It seems complex, but each line serves a very precise purpose, building on the one before it, leading directly to that final calculation, all dictated by the instructions. Understanding that flow is just essential for preparing an accurate Form 1120. It gives you that complete picture of what needs doing and why each step matters.
That detailed walkthrough is super helpful. It really demystifies the mechanics. But now, maybe let's zoom out for a second. Let's reflect on that core principle that guided our 14-year-old entrepreneur through this whole maze. That unwavering commitment to just sticking to the script, following the exact written word of the law, no personal interpretation, no paraphrasing.
That strict obedience, as the sources called it.
Right. It wasn't just about getting the right number in the box. It was about understanding why that number was right, based only on what the law actually said.
And that commitment to factual precision, it even led them down this fascinating little side row, according to our sources. They started questioning the origins of the statutory language itself, like wondering if terms like Section 501 were actually in the original act of Congress that created the law, or if maybe they were added later by the government office that compiles the U.S. Code, the Office of the Law Revision Council.
That's incredibly insightful for a 14-year-old. Questioning the source of the source shows a real dedication to authenticity.
Absolutely. And our sources provided the answer. The official text of the 1966 Revenue Act, Public Law 89-809, 80 Stat 1577, it did actually cite Section 501 directly. So that confirmed the language we see in the U.S. Code today was indeed present in the original legislation. It wasn't added later. And furthermore, it clarified, citing the law about that office to U.S.C. Section 285A, that the Law Revision Council's job is to compile and organize existing law, not to create it or change its meaning. They put the pieces together systematically.
Okay, so that detour actually reinforces the integrity of the official U.S. Code as reflecting the original law.
Precisely. And why does this little detail matter so much? Because that intellectual curiosity, that brief investigation, it powerfully reinforces the absolute necessity of relying on direct, verifiable sources in tax law. Any deviation paraphrasing what you think it means Making an assumption, however reasonable it seems, can lead straight to errors, costly errors, potential penalties, maybe even legal trouble.
Yep.
When you're dealing with the IRS, that level of precision isn't optional. You just can't afford to guess or interpret. You have to know what the law actually says.
And that brings it right back to you, the listener. The lesson here is just profound, isn't it? When you're navigating something as incredibly precise and rule-bound as tax law, every single word, every instruction, every citation from the IRS, from the Internal Revenue Code, it's there for a specific reason. There is simply no room for guesswork. No close enough, not what you think it might mean. It has to be what it actually says. And just to quickly connect that back to the form itself, remember that summary table concept from our sources? It explicitly showed accounts receivable balance. Schedule L, line 2A, gross receipts, Form 1120, line 1, bad debt deduction, line 15, deferred tax assets. Schedule L, line 14, with a schedule attached. Financial assets. Schedule L, lines 5-7, capital gains losses. Schedule D, attached.
That maps it all out.
Exactly. It's
Yeah.
not just a random list. It proves the systematic, line-by-line nature of the instructions. They demand exact adherence. And that level of detail, yeah, it can seem daunting at first, but ultimately it's what provides the clarity and the confidence that you're doing it right.
Yeah, ultimately, being able to quote directly, precisely from those official IRS documents, from the code sections, that really is the gold standard of factual mastery in this whole area. This deep dive, I hope, has shown you exactly that kind of mastery. It demonstrates how taking a rigorous source-driven approach can truly demystify even the most complex bits of corporate tax. It provides a clear path for anyone to understand not just what to do, but crucially, why it's done that way.
So there you have it. We've taken quite a journey through Form 1120, haven't we? Decoding all those intricacies, all guided by the super rigorous, fact-based approach of that remarkable young entrepreneur. We've looked at the critical differences between corporate entity types, their filing forms. We dove deep into reporting specific items like accounts receivable, deferred tax assets, financial investments, especially under accrual accounting. We meticulously examined key deductions like bad debts and NOLs. And maybe most importantly, we kept coming back to the absolute non-negotiable importance of sticking to the direct word-for-word language of the IRS and the Internal Revenue Code.
Yeah, the key takeaway I think is undeniable. In this complex world of corporate tax, understanding the exact statutory authority, the official instructions, it isn't just helpful, it's absolutely essential for compliance, yes, but also just for clarity. It cuts through the ambiguity, builds that solid foundation for accurate financial reporting. It lets you confidently navigate the what to do because you have the backing of that precise legal understanding, the why.
Which leads to a final thought. Given this incredibly precise nature of tax law and the kind of diligent adherence, that strict obedience required for accurate reporting, what implications does that level of detail, that way of thinking, have for how we approach any complex system in our lives? Where else might that kind of strict adherence to foundational, verifiable rules lead to mastery and clarity? Beyond just tax forms. Could applying that same rigor maybe transform how you learn a new skill, tackle a complex project at work, or even understand, say, scientific principles? Something to think about. We really encourage you to continue your own deep dives, equipped with this understanding. See where that commitment to facts takes you. Until next time, keep digging.